Well, thank you, President Harker and Jalapa and everyone at the Philadelphia Fed for putting this together. Today, I want to talk a bit more about what Pat just referenced, how the plumbing and pipes of our economy and how they're regulated. Like transportation, telecommunications, and energy, our country's payment system is essential infrastructure. And when I mention regulations, I'm not just referring to regulations developed by governmental entities. I also mean the regulations imposed by private actors outside of the democratic process. Back in the day, the Federal Reserve System helped to create wire transfers and check clearing and so much of the pipes in the payment system. And the private sector, as Pat mentioned, has also built rails over time that help households and businesses move money. This public-private partnership and governance has also always been essential. And throughout our history, we have seen the consequences when these essential facilities succumb to unchecked private control, and this can undermine the economy and the free market. Now, while speculative trading of crypto assets has garnered a whole lot of attention the last few years, the changing landscape of consumer payments, and especially point-of-sale payments, has been more under the radar. Over the last decade, but particularly during the pandemic, big tech companies have started to creep into the payments ecosystem to deepen consumer engagement on their platforms, harvest and potentially monetize transactions-related data, and exploit traditional financial sector fee streams. And this trend mirrors many of the methods we have seen by the likes of Alipay and WeChat Pay in China. In 2021, the CFPB launched an ongoing inquiry into this payments market evolution. Today, the CFPB is releasing the next set of findings in this inquiry, an analysis of the outsized influence that companies like Apple and Google exert over popular contactless payment options. In my remarks, I'll discuss the role of big tech companies in mobile payments, particularly those made at point of sale. I'll outline some of the shifts during the pandemic and describe the regulations imposed on third-party payment apps, including banks and small fintechs, by the two dominant mobile operating systems operated by Apple and Google. And I'll close with some implications for the future of open banking and payments in our country. I should note that the accelerating trend toward digital transactions has profound implications for financial privacy and stability. But for today's discussion, I will set aside the debate over whether and under what terms policymakers should pursue a digital equivalent of cash. Facebook's failed Libra scheme, other big tech expansion into payments, and the more recent announcement of PayPal's private currency all underscore the breadth of the issues related to consumer payments. And just like Pat, of course, the views I express today reflect the views of the CFPB and do not necessarily reflect those of any other part of the Federal Reserve System. I'll start by going into some detail about how the pandemic accelerated some of the shifts, particularly in point-of-sale payments. We've all seen this firsthand. Using cash to buy groceries, fill up your gas tank, or eat out at a restaurant is just becoming less common. In recent years, we have seen more and more Americans use physical cards, particularly credit and debit cards issued by financial firms using payment networks like Visa and MasterCard. And these cards, we all know this, may even have had a physical raised number that you can feel. And this was a texture that merchants could use to take a physical imprint of the card. And over time, merchants then began to rely on magnetic stripes to record transactions, and then, of course, to combat the rising fraud with that, from skimmers and other devices that could easily read those stripes, credit and debit cards eventually adopted EMV chip technology. And the complex architecture of the chip made it near impossible to replicate and enhanced interoperability of transactions throughout the globe. Other developments also started to emerge and shape the industry. You might enter an office building or unlock your car using keyless technology like radio frequency identification or RFID. A related technology known as near-field communications or NFC has become as significant in the payments ecosystem as payment cards started to embed NFC capabilities in the chip. And this facilitated the emergence of tap to pay. A little over a decade ago, the adoption of contactless payments using NFC technology in mobile phones started to grow. And this technology could securely transmit the digital payment of a user for verification in making transactions. And as President Harker mentioned, those cards were no longer cards, but in fact, a digital imprint now transmitted through NFC. Payment systems are by their nature networks. It doesn't work to have a million of them. You have to have ones that work with each other. So it's an appealing target for big tech firms since they can leverage their existing vast user bases and troves of other data to expand into the market. And as NFC technology enabled smartphones to double as contactless payment devices, those manufacturing and developing mobile operating systems saw a clear opportunity to move deeper into payments. And while there have been other contactless methods to hit the market, such as the apps like Venmo, Cash App, and PayPal, these apps typically require more manual data entry or the scanning of a quick response code or QR code. Consumers and retailers in the U.S. report this is more cumbersome, though, than using tap to pay through NFC. And of course, the pandemic accelerated much of this. These instruments now outpace cash, meaning credit and debit cards. And one study found that between 2019 and 2022, use of cash as a payment method dropped around 10%, while the use of digital wallets jumping by around 40%. We saw the acceleration in e-commerce, but even as Americans returned to in-person shopping, consumers and merchants further embrace contactless payments through NFC. Overall, roughly 3 in 4 of the 130 million iPhone users have activated Apple Pay, with nearly 56 million U.S. consumers making an in-store payment using Apple Pay in April of 2023, accounting for nearly half of iOS users. And in 2021, there were an estimated 25 million Google Pay users, which is forecast to grow by another 10 million users by 2025. Visa recently reported that 1 in 3 Americans use tap to pay for purchases, 7 times the rate from 3 years ago. And MasterCard reported that contactless payments globally account for 60% of these in-person transactions. So as contactless payments through mobile devices continues to grow, it's important to look at the regulations imposed by the operating systems that govern the guts of our phones and other wearable devices. The U.S. mobile phone market is dominated by 2 entities, Apple and Google. The operating systems set the parameters for how the core software on a phone works. They dictate how apps can be downloaded and installed, as well as how some of the phone's features work, including the NFC capability. Apple's iOS is an operating system exclusively for Apple devices like iPhones and iPads. Google's Android operating system is installed on phones made by a range of handset manufacturers. While you can generally get to any website through a browser on these mobile devices, Apple and Google impose a number of regulations on the apps you can download through Apple's App Store and Google's Play Store. If an app does not comply with their regulations, the app can be denied access or face removal, making it essentially inaccessible for an app to be in a mobile device. There's no comparable gatekeeper, as we know, for accessing service through a web browser. And this brings me back to the future of payments. In a more open and decentralized payments market, we would expect that there would be a plethora of players leveraging tap-to-pay functionalities. We might expect to see lots of companies and financial firms working to integrate it into their existing mobile apps the same way we have seen so many integrate GPS or the camera into their app. However, we just don't find this at all. We found that Apple's regulations forbid any third-party apps from accessing the mobile device's NFC technology for contactless payments. All NFC-enabled payments must go through Apple Pay, and card issuers must pay a fee to Apple for that privilege. As a result, many popular payment apps cannot directly use Tap to Pay. On the other hand, Google's current regulations do not require that the payments are routed through Google's proprietary wallet. And over time, we have seen some level of tap-to-pay competition and innovation on Android devices. Google, however, has been scrutinized by international authorities in the past for allegedly placing self-preferencing conditions on device manufacturers that run on Android. Apple has cited security and privacy as the justification for restricting third-party access to the NFC technology, and data protection is certainly paramount for consumer-sensitive financial information. But it is not clear that a blanket NFC access ban is necessary to protect data security and privacy, and it may be that the company could place privacy and security restrictions on third-party apps as it does for apps and other functionalities. There have been particularly strong reactions to Apple's regulations in the U.S. and in jurisdictions around the world. For example, last summer, a small Iowa credit union filed a major class action lawsuit against Apple, alleging that the company's NFC access restrictions might violate federal antitrust laws. The European Commission has charged Apple with illegally abusing its market power to self-preference Apple Pay through the NFC access policy. And many other competition, consumer, data and privacy, and financial authorities have expressed concerns with this policy. Today's analysis by CFPB staff discusses potential downstream effects of the policies, and I won't go through all of their findings, but you can read it in the report we released today. But suffice it to say, there are real concerns that such policies may create potential roadblocks to a more open, decentralized, and innovative payments ecosystem in the U.S. I'll close by sharing some more about those implications. As I mentioned before, there are many examples throughout history where the Federal Reserve System has worked to ensure that the payment systems operated as an essential utility for the economy. I think President Harker used the term fair and equitable. In its early days, Federal Reserve banks developed a wire service using the telegraph. It now operates today as FedWire, using more modern technology. And over 100 years ago, it established central check clearing. The Fed has operated one of the two ACH networks, with the other network largely controlled by the industry. And more recently, the Fed launched the FedNow Real-Time Payments Network that banks and credit unions, large and small, are eligible to offer to their customers. And these services have provided an important check against control and dominance over essential infrastructure by private gatekeepers. And a key priority for the CFPB is to accelerate the shift to open banking and payments in our increasingly digital world. We think this will help people get paid faster, access more attractive rates on deposits and loans, switch more easily, avoid intrusive surveillance, and minimize the consequences of inaccurate credit reporting and scoring. And next month, we will be proposing rules to activate a dormant authority authorized by Congress in 2010 that will give consumers more control over their personal financial data rights. And we hope this will intensify competition across financial products by allowing consumers to securely permission their data and switch more easily. However, the rules, while they will help, we know that the existing financial market structure is full of choke points and toll booths imposed by firms. And in many cases, they are acting as mini governments that can privately regulate markets and distort outcomes, particularly when it comes to payments. The rise of big tech in banking and payments raises a whole new set of challenges and some old fundamental ones. Google has given many of us a small introductory cash balance to use on Google Pay. Apple is launching a buy now, pay later product. Amazon is developing a palm reader to allow people to use their hand like an NFC device for payments and secure entry. And other big tech companies have quietly accumulated money transmission licenses in states across the country. And the list goes on and on. I agree that we need strong challenges to dominant Wall Street banks and card networks, but there is real concern that the largest technology firms will be able to erect even more gates and toll booths that will prevent the smallest firms from emerging, raising capital, growing, and succeeding, even when they offer superior technology. Moreover, the blurring of digital commerce, lending, and payments raises other questions about the separation of banking and commerce that we have observed in our country, providing a new twist on debates that date back to the earliest days of the Republic, discussed just steps away from where we are sitting today. And as the U.S. continues its bumpy path toward a more open, interoperable banking and payment system that supports the entire economy, it's going to require a close examination about how big tech's business practices and private regulations might impede that goal. Given how essential this is for our country, we must ensure that payments in the U.S. are fair to consumers, merchants, nascent competitors, and creators of all sizes. And it will require more work across the Federal Reserve System, including by the CFPB and Federal Reserve banks. Thank you very much.
Can you hear me?
Yeah.
Okay. Rohit, thank you. That was very, very interesting and stimulating. Let me follow up with a few questions. You are making it clear that you want to see, you think we need a more open, as you said, decentralized and innovative payment system. Your remarks make clear that you think today Apple and Google in particular are kind of choke points in terms of the ability of others to get their apps on the system. Is that enough? Let's say we somehow create more access there. Is that enough? And I guess what I'm referring to is, do you think of that as sufficient in terms of the rails for payments?
No. So I think one of the things we think about quite a bit is the reason the U.S. has actually, I believe, outpaced not just in advanced technology, science, engineering, but across the economy, is because we've tended to favor market structures and have a cultural predisposition that much of the innovation is done by the newest and smallest firms in the economy. So when you have newer and small firms that have a great product or a great technology, and they cannot get to market, they cannot raise funds. And I can't tell you how many times you hear from Fintech VC, others, they want to ask before putting capital in, who can stomp you out? Who can block you? So we as the regulators, we have to make sure that consumers, businesses, others have rights, make sure they can access their data, use it, reduce switching friction and others. But it requires a very holistic look at what are the blockades and obstacle courses about getting to market. And one of the things I fear is we sometimes talk very loosey-goosey about payments. There's such different use cases, particularly in consumer payments. And I think that this one area where the use of a mobile device, a watch, whatever it may be, we need to think about what is the governance of that. And, my hotel was across the street from the Second Bank of the United States. For those of you who know history, we've had some experiments that didn't work when it came to private currency and gatekeeping. And I think, as Pat mentioned earlier, there has been a huge role for public governance to make sure that there is some opportunities for things to move fairly and rails that are non-discriminatory. And I think that's going to require us to look at how to regulate it and really how to think about these private regulations imposed by gatekeepers.
But let's broaden the parameters. We've obviously got stablecoins out there, and some people would say, look, those could have a broader application to payments, but we don't have today really a regulatory framework that allows that. Bank regulators today have tried to limit the connections between stablecoins and the banking sector. And frankly, a lot of people would say, well, decentralized distributed ledger technology poses a lot of risks of illicit activity, of resilience, of what's the governance. On the other hand, you mentioned Libra. And leaving aside the baggage that was associated with Facebook over that proposal, they were saying, well, let us create a permissioned blockchain, and we won't have those illicit activity risks. And we won't have the resilience risks, because we'll make sure that anybody who accesses it is verified. How do you think about those broader issues?
Well, we could spend the whole day talking about Libra, but I think what I think about in that context is, yes, there obviously does need to be an embrace that we will move money in different ways, and we should always assume that we will do that. I think we want to understand what's the right role for the banks, which, by the way, is a publicly chartered, set of institutions that enjoy the safety net of the discount window, federal deposit insurance, others, and what goes elsewhere. But even if you have stable coins, even if you have another payment instruments, you still need to look at the market context through which it is going to be transmitted. And I do think sometimes we focus a little bit too hard on big commercial payments or e-commerce transactions that, buying something online. There really is quite a range, and each of them has some different challenges and issues. And it's not just about regulating properly, but I think it's also about what is the role of the reserve banks and other public infrastructure to make sure that there is some choice and also a check on any of those rails being blocked or dominated.
So following up on that, this is obviously a Fintech conference where a lot of people are concerned about the ability of fintechs to engage in partnerships with banks and do other things. You've been, I think it's fair to say, a little more, if you will, supportive of fintech as a possible way of increasing access, increasing inclusion, although obviously there have been concerns from bank regulators and people in Congress about whether fintech can live up to that. President Harder referred to the rollout of FedNow. Some people would say, well, FedNow is not going to work unless you allow fintechs and others to have greater access to the system.
Yeah, so I would agree. I think institutionally, since the creation of the CFPB, we don't have skin in the game versus in this bank versus non-bank. I think everyone is kind of seen as we regulate equally. We see the benefits of the competitive pressure across the system. I guess what I would say is I think you want to see the innovation. We talk about AI, quantum computing, things that we're talking about daily, every week as regulators. You want to see innovation based on true technology and true solving of consumer problems than what I would call the regulatory arbitrage rent-a-bank model. What's the way to kind of get around it? Because to me, that's actually not meaningful value creation. You're just, that's, and no offense to those of you who are, but it's value creation by the lawyers, not the creators. And I think that's the place where ultimately you want to create a regulatory framework that allows for that. If you diagnose what the challenges that they have, you get a more textured picture than some of the broad strokes that are relayed.
So how do you see the CFPB advancing that goal in the remaining, well, I shouldn't say remaining. We have a presidential election. We'll have an inauguration in 16 months. You may or may not be in the job after that, but you know you have at least 16 months. How do you see the CFPB advancing that agenda? You're putting out this analysis today.
Yeah. Well, one of the things, actually, that is 501 days from today until January 20th.
Who's counting?
So I guess I would say this. One of the things that we are doing is, and I think that the fintech ecosystem started, and I mean real fintech, not like a company that has a website and calls it fintech. They know that they actually need the CFPB to provide, I think, more of the focus expertise on how to make sure that the old regulations that were inherited from these agencies are administered in ways that actually make sense for today's market realities. I mentioned earlier, we're going to be proposing rules next month to activate Section 1033 of the Dodd-Frank Act. That, I think, is going to be, over time, a big push forward. We are going to be revisiting some of the regulations on the Fair Credit Reporting Act, which actually governs quite a bit of consumer data and privacy. We spend quite a bit of time also talking to our international counterparts and central bankers about the future of the payment systems and the firms operating in this space. I think 10 years ago, people would have thought, well, the CFPB is a very domestic-focused agency. That's still true. But the firms that we are now overseeing, buy now, pay later, payments, there's many others, they really are operating across jurisdictions. And I think we have a whole set of tools to which we are addressing it. Payments is, of course, closely linked to deposits and what the overdraft. You know, much of overdraft is simply a timing mismatch. The work of the CFPB staff on thinking through payments and overdraft, I think, has led to major shifts in the market for which we're continuing to see progress. So I would expect a lot, in these next few years.
Well, let me ask you to reflect generally then on, you've been in office 2 years, almost 2 years. You've got 501 days to go at least.
I have a 5-year term, but I can stay longer.
At least. What else are your priorities as you think about the time you have?
I will share that one of the places that when I arrived at the CFPB, I was surprised that there was not as much readiness throughout the Federal Reserve System on the pace of technological change that are really fundamental ones. I mean, QC being one of them. So we have really, shifted a lot of the work to what I would call the non-bank side of the house. We have shifted more of the work to thinking about the future of financial data. We have recruited people that really are more technologist-type skill sets, the ones who actually know how to break an AI, and trying to make sure that we are issuing constantly the right regulatory guidance and interpretations to allow the smallest firms to know what is expected of them rather than having, a lawyer they have to pay big money to. So we see really the future part as a big emphasis of what we have been doing and what we will do. And of course, we live in a state of constant paranoia. Our agency was created because a regulatory failure of epic proportion to properly watchdog the mortgage industry tanked the economy. And so that is our mindset as well, of being ready for any risk and being able to respond appropriately so that it does not infect the rest of the system. So those two things are broad ethos, but of course there's a lot of detail on the law enforcement side, the regulatory side, and frankly the work we are doing to promote entry, competition, and innovation.
You mentioned AI. You mentioned your priority to get people into the agency who have the kind of data and technology skills that you need as you look forward. how else do you think about the intersection, if you will, of AI and the CFPB priorities and jurisdiction?
One of the things we have been leading across the government with some of the other agencies is trying to make very clear there's not a fancy technology exception to the laws. So, for example, there is a longstanding law that says when you deny someone credit, you got to give them a statement of reasons as to why. So if you can't figure out the reasons why your algorithm is spitting out a denial, you can't use it. So I think we're trying to put in more simple terms about what the existing laws say. And by the way, there's a lot baked into that, important value of transparency, important value of accountability. There's so many pieces of AI. I separate in some ways the lending and underwriting from the targeted marketing to, there's many places to use it. But the bottom line is that we have to have some appreciation that consumer data and consumer financial data, weirdly, is going to help us move back to the basics of lending and banking. Lending and banking fundamentally was about ability to repay. At some point, for a whole host of reasons, good and bad, it turned into three-digit scoring. And it turned into something that was not about cash flow. And I'm hoping that we'll be able to use data to get to that basics of lending and banking, but not at the expense of using it for manipulation, weaponization, deception. On generative AI in particular, we have published our analysis of chatbots in the banking industry. We have big concerns about the use of certain types of technologies for authentication, voice cloning. There's so many ways in which financial institutions thought it was safe. So the data protection part of our mandate, we administer the Fair Credit Reporting Act. We administer the Gramm-Leach-Bliley privacy rules. That's going to be a very key part of this as well.
I would love to follow up on all of those things, but I regret we're out of time. But thank you so much, Rohit.
Thank you,
Tim. It's been a pleasure.